In the United States, the real GDP dipped 0.3% quarter-over-quarter in the first quarter of 2025, yet the domestic engine is still running hot. Consumers lifted spending 1.8%, equipment CapEx jumped 22.5%, and both labor market and retail dashboards remain solid. Core PCE is drifting toward 3.3% as new tariffs filter through prices, and households have front-loaded purchases of autos and electronics, pushing vehicle sales near record highs. Portfolio stance: neutral to slight overweight large-cap U.S. stocks, emphasizing quality and low volatility factors. On rates, pair ample liquidity in T-bills with a measured slice of 10-year Treasuries to build a barbell that captures carry while guarding against a later growth downshift. Eurozone: the blocked-out 0.2% GDP growth in Q1 and headline inflation slid to 2.2% in March, the midpoint of the ECB's target. Yet rising trade frictions with Washington are damping sentiment. Policymakers are openly flagging rate cuts if conditions worsen. Investment-grade euro credit screens attractive, and within equities a benchmark weight allocation tilted toward healthcare and consumer staples offers defense. Expect the euro to stay range-bound unless trade tensions break decisively. In China, GDP surprised on the upside at 5.4% year-over-year, but that strength is overshadowed by Washington's new 145% tariff and Beijing's 125% response. Markets anticipate further policy support via benchmark rate and RRR cuts. Stay selectively overweight onshore, A-shares linked to domestic consumption and policy themes, avoid export-heavy manufacturers, and hedge CNY exposure as volatility rises. Onshore, government and high-grade policy bank bonds remain an effective carry play. The UK faces a stagflation-tinged mix, 0.8% expected GDP growth and inflation peaking near 3.6% by autumn. Global trade disruption and cost pressures curb momentum, but a service-heavy economy and forthcoming BOE rate cuts should avert outright contraction. Intermediate duration gilts supply duration ballast, while FTSE 100 multinationals with foreign currency earnings are preferable in equities. Within sterling credit, stay short-dated and high quality. The IMF has trimmed its 2025 world growth call and lifted its inflation view, citing tariff-driven uncertainty, a recipe for wider earnings dispersion. A diversified strategic core of 50 to 60% global equities, 30 to 35% high-grade bonds, and 5 to 10% real assets, gold, broad commodities, still looks robust, supplemented by 5 to 10% cash to deploy into tariff-induced sell-offs. Within equities, favor free cash flow visibility. Within bonds, own duration where central banks skew dovish. U.S. Treasuries offer the most attractive real yields. Bottom line, persistent trade friction elevates idiosyncratic risk, making disciplined asset allocation, not market timing, the investor's best defense.